Mind the gap, the disconnect between what the Fed is signaling versus what markets expect it to do is creating a volatile backdrop amid ongoing concern that the financial stability risks have not entirely subsided. The immediate shock may have passed, but experts say more gloom is to come. Here's what so-called Dr. Doom Nouriel Roubini had to say yesterday.
The worst is still ahead of us. The business model of many regional banks is broken. They have a narrow deposit base. They have a large amount of uninsured deposits. They had massive losses on their securities. Even the value of their loans is falling. They have exposure to commercial real estate. And many of them, if you measure it correctly, given the changes in interest rates, are now insolvent.
So if banks aren't yet in the clear, how much danger is the wider economy in? Here with more, Marta Norton, Morningstar Wealth Chief Investment Officer, America's Marta, thanks so much for joining us. We have bank earnings kicking off tomorrow. It's the regionals that are going to be closely watched. We've seen a drawdown in their stocks. You're saying proceed with caution when it comes to this space. Is there further risk on the horizon given the recent bank turmoil?
And Ness, I think there's no question that we're in a period of pretty great uncertainty. If we look back to past crises of a similar ilk. Now, you could look at the great financial crisis, you could look at the savings and loan crisis, but one of the things that you observe from these periods is that they're slow moving, that they're rolling over time. And so while I think there's a big temptation to call any sort of crisis over and done as soon as the initial panic subsides, I think there's always reason to have kind of a bound of uncertainty around those types of calls and leave some room for the possibility that we could see more turmoil to come. So I think that's what we, and I think a lot of other investors are going to be watching as we see bank earnings come out in the next week or so.
And the Fed minutes earlier this week showed that the Federal Reserve is expecting a mild recession. You've got the White House that's pushing back, that's saying there's no recession on the horizon. We just saw jobless claims coming in a little bit higher than expected last week. So we have seen a little bit of a slowdown when it comes to the jobs market. It's still, though, a tight jobs market. Are you expecting the Fed to continue with at least a 25 basis point rate hike at its next meeting? And what is this going to do for the markets?
I think we're reaching a point where there's greater uncertainty as to what the Fed is going to do next. That said, the Fed has pushed back time and time again against an assumption that rate hikes were coming to an end. So we saw that, some concern or expectation, better said, that the Fed was going to stop raising rates when we hit peak inflation, that the Fed was going to stop raising rates when we saw that financial instability. And the Fed has continued to push into its effort to keep inflation under control. And so there's, I think, a reasonable expectation to expect at least one more rate hike in the cards. That said, I do like to put those bounds of uncertainty around things because we really are reaching a point where there's one variable after another that we're having to balance against one another.
So then how should investors position their portfolios?
Listen, what we're thinking about as we take a look at markets globally, both equities and fixed income, is that valuations are certainly improved relative to a year or so ago, but we have seen a tremendous rally. So when you're looking at the equity markets, despite, the financial instability that we're seeing, the U.S. equity market, the global equity market has done reasonably well to date, and there's still a lot of uncertainty out there. So while generally speaking, we think valuations are certainly better, long-term return prospects are certainly better than they were a few years ago, I think a bit of caution is warranted. So we're looking at things like cash and short-term bonds. We're looking at areas like consumer staples and healthcare, and we have that exposure in our portfolio to provide some sort of ballast if we see volatility creep up.
What about emerging markets?
Yeah, so emerging market valuations are looking a lot better. Now, there's this economic risk that's obviously going to impact emerging markets as well. But we see areas like China as actually a pretty attractive area, and we've seen a tremendous rally there. We also see areas like Brazil as looking pretty attractive, especially given the yield that we see from Brazilian equities. So I think those are areas of opportunity, no question, but they're not going to be necessarily protective in the event of a global economic slowdown. So you have to balance that valuation argument against the macroeconomic concerns.
You mentioned cash, more in cash. Oh, how much more are we talking about? I mean, how do you divvy up the portfolio?
Right. So it's more on the margin, I would say, that we're increasing cash. Most of our portfolios are still pretty fully invested. Some of that fully invested portfolio is in short dated bonds, which has obviously protective characteristics. But what we're looking at is you could kind of think of it almost like a laddered portfolio. We have some maybe modestly more cash by a few percentage points relative to what we would normally have. We have these safer equities like healthcare, like consumer staples. And then we have areas that are far more opportunistic when you're thinking about China, Brazil, even some areas of like European financials, European energy that still look relatively attractive to us. So it's really going across that entire risk spectrum, predicated on valuation.